We had another strong day in the U.S. stock market with the S&P 500 rising about 0.74%. We had about 63% of stocks closing in the green, so it was not an overwhelming day for the bulls. But we did have some key advancers. In particular, Microsoft and Nvidia continued firing on all cylinders, in some cases hitting all-time highs there with that AI-driven theme powering this entire market forward. We also saw some very nice participation out of the financials today. Charles Schwab was actually the best performing stock in the S&P 500, and not too far behind them were Morgan Stanley and Bank of America. So all of a sudden we're starting to see this market rally broaden out to a few other areas. So we'll take a look at all of that, see what it means for our postures. We'll also do some sector evaluation in tonight's video, and then we'll get into a trade application example where I show you how to do an iron condor on an ETF, so that way you don't have to worry about earnings season quite as much with individual stock names. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 18th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. We'll also show you at the bottom of those emails which stocks are giving you overbought and oversold cluster signals that day. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. At Brandon Van Zee is my handle. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, we've got the S&P 500 heat map pulled up here in front of us. Pretty interesting day in the market. We did close nicely higher here today, but it wasn't quite a one-sided victory the way that we've been seeing more often than not. This has been a remarkably bullish year that we've found ourselves in the midst of in 2023, and it almost feels like every single day the market is up. I know that's not the case, but it kind of feels that way. Today we had plenty of selling within the market, but we still had the winners outnumbering the losers. The one that really catches my eye, some of you saw me tweeting about this one earlier today when I jubilantly announced that Microsoft, or as I called it, Mr. Softy, was hitting all-time highs. Remember, Microsoft was amongst the companies hitting highs when the NASDAQ was hitting its all-time high in November of 2021. Since then, of course, Microsoft, along with a lot of other tech companies, fell precipitously in 2022, but have had a remarkable and miraculous rebound since the beginning of this year in particular. Of course, Microsoft is a key beneficiary of this push into artificial intelligence with their $10 billion purchase, or not purchase, but equity stake within ChatGPT. Today, Microsoft had some news that they announced that they are going to be adding on an additional kind of recurring revenue stream for some users to use a form of artificial intelligence for, I think it was $30 per month, which was more than what analysts were expecting. So who knows if that will become a big new revenue stream for Microsoft, which already has a ton of revenue streams with Office and the gaming division, of course, that's been in the news here lately with trying to take over Activision. But of course, they've had the Xbox division for a long time, and who could forget their cloud division, right? So Microsoft already has a lot of recurring revenue streams. Today, they supposedly are adding an additional one that got the analyst community excited. So Microsoft was actually up about 5% earlier in the session. It did pull back a little bit off of its highs. Nonetheless, it did close up about 4% here today. Microsoft is one of the rare specimens out there that we had the good fortune of buying in one of my dividend growth investing classes many years ago, and we also currently own it in our top-down trend trading class as a coffee can stock, meaning that it started as a trend trade, it ended up doubling for us, and we sold half of our shares. Actually, ironically enough, when we sold our half of shares, it was on the day that it topped back in November of 2021, and it wasn't until here more recently where the stock was able to get back up and over that area. But we still hold half of our shares that we've had, and we've had them for several years at this point. So it's treated us quite well. We're thankful for that. Speaking of coffee can stocks, NVIDIA, of course, a more recent coffee can stock of ours. That one we kind of flirted with here and there over the years, but more recently bought it in February. It did end up doubling for us about 4 months later, where we sold half of our shares and now are playing with the house's money on the rest. I think we sold half of our shares around, I want to say it was like 430 or something like that. It's at 475 right now, so you can see that it has just continued to coast ever higher to all-time highs. It is now a $1.1 trillion company, and it was up nicely here today, 2%, so that helped the market's buoyancy. We also saw that Tesla had a reasonably good day. It was up 1% today. United Healthcare, of course, the biggest healthcare company in the United States these days, it was up 3% today. Some of you may be following the saga of that company with the trade application example I did in one of these here videos a month or so ago, whenever it was. But we still have that trade. It's still live right now, and it was an iron condor. And for the first half of the trade, it looked pretty ugly, like we were going to end up having to take some losses on it. But then they reported earnings here last week, and that thing just sprung back into action. And now all of a sudden we find ourselves firmly in the profit territory. I think our short strike on the call side is 530. Today it ended exactly at 500 to the penny. How about that? 500.00. So as long as it doesn't erupt $30 per share between now and Friday, that should be a max gain winner for our iron condor there. Netflix also had a very robust day. It was up 5.5%. Netflix has kind of been, in a strange way, forgotten about this year. I say that only in relative sense because, of course, most people recognize it is an absolute behemoth within media these days. But remember, it was about 3-4 years ago we were talking about FANG all the time, and Netflix was the N in FANG. Now, because everybody's talking about the Magnificent Seven in 2023, Netflix is not in that Magnificent Seven. Not to say that it shouldn't be. It's had a remarkable move in its own right. It's just that from a market cap perspective, it can't really hang with the trillion-dollar companies quite yet. Netflix is only a $200 billion company, yet despite that, it was up 5% here today, so a stellar day out of Netflix. Then you'll see a lot of green popping up down below in the financial sector. We had one heck of a rally in a lot of those big financial companies here today. Bank of America was one of those companies that reported their earnings, and their stock was up 4.4%, so I'm sure that's making Berkshire Hathaway and Warren Buffett happy, all else being equal. We also saw a stellar move out of Morgan Stanley, who also reported earnings today. They were up 6.45%, and then not to be outdone by either of those two was the venerable Charles Schwab. And of course, many of you are probably Charles Schwab clients. If you're not yet, you could very well become one within the next year. Many of you, if you don't know the roots of David and I's history of how this video got developed and all of that, we used to work with one another at TD Ameritrade. And so most of our current clients and most of the clients we used to know knew us from our old TD Ameritrade days. So we still have a very strong following of people who use TD Ameritrade as their brokerage. And most of you are aware that Charles Schwab has already announced that they are purchasing TD Ameritrade, and actually the deal itself is done. Now it just comes the transition of accounts over to Schwab, and that is expected to be basically wrapped up by this time next year. So if you haven't gone through that transition yet, you're probably going to be going through that transition here within the next few months. But anyway, Charles Schwab was the best performing stock in the entire S&P 500 today, and as I was joking on Twitter, I said, I'm old enough to remember when Charles Schwab was supposed to be the next bank that failed. And of course, I was just joking about that, but most of you know where I'm going with that statement, because back in March, things were looking pretty ugly for Charles Schwab as the stock was just spiraling lower, and a lot of people felt like there was a chance that it could go the same way that Silicon Valley Bank did due to some of their bond holdings that were underwater, and the fact that they were, kind of a West Coast base for the most part, similar to Silicon Valley. So anyway, I never really bought into that belief myself, but obviously there were plenty that did. Charles Schwab has shown that it has no intention of going under at this point, and today was definitely a feather in the cap of the bulls, who might have even taken advantage of that plunging share price back in March. Today it vaulted higher by 12.5%. So stellar day there for the best performing stock in the S&P 500. Congrats to all of you Charles Schwab shareholders out there. We also had a fairly nice green patch here in the energy sector. Notice that it was mostly the smaller energy companies that seemed to do a bit better today. For whatever reason, Exxon and Chevron kind of sat it out, but we had a big move out of EOG, up over 3%. Conoco was up 2%. Phillips 66 was up over 2%. Devon was up over 3%. So it does seem like there was some life there in the energy world as well. I would also quickly mention that a number of the transports have come to life. Remember, technically, the transports are not a separate sector. They are a subsector, or some of you might refer to them as an industry within the industrial sector. And so some of the key transports out there, FedEx hit a new high. It was up almost 3% today. UPS was up 1% today. Union Pacific was up over 1%. CSX was up over 1%. Norfolk Southern was up almost 1%. Old Dominion was up. JB Hunt was up. Some of you might have caught my my tweet here on, I think, Friday, when I was talking about how, remember, it wasn't so long ago that everybody hated the railroads too, partly due to their own doing. In other words, Norfolk Southern, of course, had that horrible accident, but you couldn't go very long without hearing somebody on CNBC or Bloomberg or Fox Business or what have you talking about how terrible the railroad companies were. Well, if you look at those charts, they've all bounced back very nicely as well. So for those of you that are Dow theorists out there, you'll be happy to know that the transports are now carrying their own weight, so to speak. Now let's talk about those that didn't fare quite as well today. You can see that Alphabet probably stands out quite dramatically to us. It was not a terrible day for Alphabet, but the fact that they are one of the bigger companies out there and didn't participate on an up day in the market was a little bit of a head scratcher, until you remind yourself as to what the major news story was today, in particular with Microsoft. So it seems like these two heavyweights, Alphabet and Microsoft, have been taking body blows and kind of giving each other, some uppercuts here and there, but it just seems like, depending upon the day, one of them will announce some big news around artificial intelligence and the other one will get hit, and then a week later the other one will come out with some big news story and then the other one will get hit. So it kind of feels like 2 steps forward, 1 step back. These companies, of course, have done quite well over time, but it really kind of depends upon the news flow of the day, as these two are going to be a couple of the titans that lead us into the new AI era that we all anticipate heading into. You can also see that Apple kind of sat out today's rally. Now, it didn't really have much of a down day. It was only down 0.13%, so call it flat. But they've been on a pretty sizable roll here lately as well. Meta had a quiet day. It was only up about 0.5% here. Amazon did sit out today's rally. It was down 0.55%. Remember, Amazon was very much in the news last week because of Prime Day. In fact, I'm still getting packages delivered to me here today from some of my Prime Day shopping. So I'm sure I wasn't alone in that regard. And they made a ton of revenues as a result of that fictitious holiday that they just came up with out of the blue several years ago, and for whatever reason it works. We kind of like to shop in the United States. So Amazon may be cooling off a little bit here today as a result of the great success that they saw last week. In terms of other areas where we saw a little bit more red than green, I would probably throw the consumer staples in there. Notice that the consumer staples, a lot of the bigger players like Pepsi and Coke and Monster and Walmart, Philip Morris, Kimberly-Clark, they all sat out today's rally. This was kind of more of a risk-on type of a day where the defensive areas are kind of just, holding back. They also have a little bit of inflationary pressures and a few things that they're trying to deal with right now. You also saw that the utilities really struggled today. You saw that the real estate investment trusts did as well. Prologis was, I think, the worst or one of the worst companies in the S&P 500 today. It was down over 3%. Lockheed Martin also down just a touch over 3% here today. I think they had earnings as well. But utilities, really stands out to my eye as far as the consistency of the selling here today, where we only had just a handful that were up. It looks like AES was up just a skosh. We had energy up just a little bit, and then Entergy was up a little bit as well. Otherwise, it looks like most of those other squares and rectangles within the utilities sector were down here today. All right, let's go ahead and now take a look at our specific numbers. Coming over here to the main part of the platform, you can see I've got the S&P 500 pulled up in our visualize area, and you can see that there were 316 out of the 500 stocks in the S&P 500 closing higher, 182 of them closing lower. So that was good for about a 63% win rate here today. So again, going back to what I had mentioned before, it wasn't the most one-sided or lopsided bullish victory here today. You had plenty of participation on the downside as well, especially when you're looking at some of those defensive areas like the staples and the utilities and the REITs, and then the actual defense companies like Lockheed Martin and some of those military contractors. Let's go ahead and take a look at our charts now, and we're going to get started here with chart 4B. This is our foregrid for the 4 major U.S. equity indices, and looking at the market forecast technical indicator that you find below each of those charts to help us establish our posture. So remember, unless you hear David and I say otherwise, if you hear us say that the posture of this index or this stock is bullish or bearish or what have you, what we're referring to is the green line on the market forecast technical indicator. It's also referred to as the intermediate line. I know some people are colorblind, and they've said in the past, it doesn't really look green to me, or some of the other colors don't, look the same to their eyes as they do to the rest of us. So certainly understand that as well. So if you would prefer the names as opposed to the colors, then that is also referred to as the intermediate line. And you can see here when we pull up all of these 4 charts that the intermediate line, the green line, is above 80 in all of these cases. Remember, you can either look at where the green line is positioned in the indicator down below, or just simply read the number, what is in the label itself. And so for the S&P 500, the intermediate reading is at 96. For the Dow Jones, it's at 93. For the NASDAQ Composite, it's at 96. And for the Russell 2000 is also at 96. So all of these are kind of really strong together all at the same time. Remember, the numbers in those labels do not go above 100. So that goes to show you how strong of a market we are in the midst of right now, when the intermediate line is basically kind of in the mid to high 90s across the board. So very good performance, and it has been for a while. This is not some sort of new information. Remember, if you've been listening to our presentations here for the last 3 months, then most of those times we've had bullish postures, especially on the S&P 500, which is kind of the main one that we talk about. But in addition to that, also on the NASDAQ Composite. You don't have to take my word for it. All you have to do is look at the color backgrounds of those charts. And you can see that for the last 3 months of this chart, there has been way more days, not even close, of charts where of candles that have a green background color. And the same thing down here with the NASDAQ Composite. In fact, that is remarkably strong on the NASDAQ Composite. Unusually strong, I would say, as well. Remember, David and I have been doing these videos for the better part of 10 years, if you stretch it back to our prior employers. And so take my word for it, this is not normal to see how strong the NASDAQ has been. In this 3-month period of this chart here, you'll notice one day that it was weekly bearish right there, 2 days where it was weekly bearish right there, 2 days where it was weekly bearish right there, and 1 day where it was weekly bearish right there. That's it. So we're talking 2 plus 2 is 4, 5, 6. Out of the last 3 months worth of candles, there have been just 6 trading days that you have not had a strongly bullish posture. Remember, we're not even talking about weekly bullish postures. It's been so strong out there, it's even hard to identify and show you what that would look like. But here's an example of where you would have a weekly bullish posture on the Dow Jones over here, where I'm circling up and to the right. Notice how that background color is that light green color as opposed to dark green. Now come back over here and look at the NASDAQ composite. We haven't had a single day for the NASDAQ composite in 3 months where we've had even a weekly bullish posture. All of them have been strongly bullish postures, with the exception of the 6 days that we had weekly bearish postures. None of them were strongly bearish. So that is about as strong as you will ever see the posture setting mechanism on a single index. In this case, the tech stocks, of course, have been leading this market for a long time on the backs of stocks like Nvidia and Microsoft and others that are participating in the artificial intelligence boom. So the NASDAQ has been truly breathtaking to witness. You will notice that 3 out of our 4 charts today also have an additional label showing up at the top of the charts. Notice that there's this green label that will show up if the security is hitting a 52-week high here today. Remember, these charts, by default, we only look at 3 months worth of data. Of course, we could change that if we wanted to, but it helps us kind of zoom in a little bit closer to see the price patterns and different things like that, as opposed to having everything all scrunched up together. So anyway, this tag up here lets us know that not only is this a 3-month high, which is obvious because you can see the high label above today's candle, but it also tells us that in the 9 months prior to what we see with this 3-month period here, this is also still the highest price out of the full 12 months going back. In fact, it's longer than that. I think it's April of 2022 is what they were saying last week was the last time we were this high in the S&P 500. So we have this little 52-week high or yearly high tag showing up on the S&P 500 today. It's also showing up on the Dow Jones Industrial Average. Remember, that one's maybe a little bit more special simply because the Dow had been lagging up until here more recently, but it caught up in a big way. And then, of course, the NASDAQ, that's not nearly as surprising as the Dow. NASDAQ also has a yearly high here today. So the only one of these 4 indices that does not have a yearly high is the Russell 2000. Of course, the Russell 2000 does tend to act a little differently than most of these other indices. Remember, part of the story behind the Russell 2000 right now is that it has a lot of exposure to the banking industry. I think over 10% of the Russell 2000 is in the banks. And so with the March upheaval in the banking industry, that did not really help the prospects of the Russell 2000 at that time, and therefore there's a little bit more upside that it needs to achieve before it's hitting multi-month or multi-year highs or anything like that like the other ones are. But it's on its way, so we shouldn't poo-poo the move that it has had. It was up 1.27% today. It was the leading index here on a 1-day basis. And again, a big chunk of that is because today was a day where the financials were really outperforming, right? We talked about Bank of America and Morgan Stanley and Schwab, and of course they're not in the Russell 2000. They're part of the larger cap index of the S&P 500. Nonetheless, a lot of times when you have your bellwethers really putting together some strong performances, a lot of the small and mid-cap players also kind of get pulled up along with it. So today was a very good day for the Russell 2000 because it has a larger allocation to the financial sector than what you find in most of these other broad-based indices that are out there. In fact, the Russell 2000 was so strong today, you actually have an overbought cluster signal. And to my eye, that is actually the very first overbought cluster signal on the Russell 2000 in the last 3 months. Today was it. So that goes to show you how strong this move has been here more recently for it. Again, I mentioned before that its intermediate number was at 96. That matches the NASDAQ and the S&P 500. Remember, up until the last week or so, we were not saying that. It was not nearly that high. In fact, it was on this 2-day pullback right here where there was a true fear that it was going to lose its bullish posture as that green line was kind of rolling over. Like if I were to right click in here maximize the sell, you can see that this green line was rolling over right here, and had it gone down one more day, it would have fallen out of the upper reversal zone and you would have seen a light pink background color appear. But then that 2-day sell-off was met with a massive 5-day rally, which basically saved it. And now you can see that the green line is pulled up along with the strength of the price action itself. So not only did we not lose our bullish posture, we went up so much that we ended up getting an overbought cluster here, which has been very, very rare for this particular index. It's the first one in at least 3 months. Let's go back a little bit further and see if we can find the last time it had one. It looks like it was nearly 6 months ago that you had it last time on the Russell 2000. You'd have to go all the way back here to January 26th. You did see that we had a big push for a week or so immediately after that, but then that kind of started that big crescendoing lower, especially with that banking crisis in March. So who knows if this is going to slow its pace down or not, but you know, some of you might be taking some of your profits, or you know, adding an element of bearishness even if you're not full out bearish by selling, let's say, a cover call on the Russell 2000 or something along those lines. The other thing that you can see here is that we are now approaching this prior high that we had about 5 months ago on the Russell 2000, where it did get up and over 2,000. So the Russell 2000 got up over 2,000 as its actual price back here on, one should know it, 2-2. A lot of twos there. So that was Groundhog's Day, February 2nd. So right now we're at 1976. A good year, a couple years before I was born there, but bicentennial here in the United States. So 1976 up here to 2007 is not that far away. Judging by the size of the candles that we've seen on the Russell 2000 here recently, you know, theoretically that could be overtaken within, you know, a week if you have enough bullishness behind it. Obviously, it's going to be a tall task for it because you've already expended so much energy just simply getting off the moving average here a couple of weeks ago. Nonetheless, we are not that far away from hitting a high there on a 6-month basis on the Russell 2000. And then let me see what it looks like from a 1-year basis. There we would have to stretch back a little bit further. Back here in August of 2022, we were able to get all the way up to 2030 on the Russell 2000. So that one won't be quite as easy to take over, but you know, it really would not be considered a miracle or anything like that for that to happen. So you know, if we woke up a month from right now and we were talking about how the Russell 2000 had joined the other 3 indices with yearly highs, that would not be entirely surprising. It's not that big of a deal from a percentage basis. So anyway, you know, it's been a nice move. Some of you would also say, well, you know, we kind of had a bit of a double top here over the past year. Maybe this will be a triple top and we will kind of fall back into that sideways chop that the Russell 2000 has spent the entirety of the last year in. And that's a possibility as well, right? You kind of got strong support down here at around 1,700, and you've got kind of stronger resistance up here closer to about 2,000. And so some of you might try to play those movements between those key numbers there as well. So we'll keep our eye on that to see if there is a breakout in the cards. But what we do know officially as of today is it has been a very, very strong move out of the small caps, and they are now amongst the strongest index out there. Speaking of overbought cluster signals, we also got one on the Dow Jones Industrial Average today. Remember, that was another one that was playing catch up, and this really started with that big move out of United Healthcare that I had mentioned earlier in the presentation. Remember, United Healthcare is one of the most important companies in the Dow Jones Industrial Average because it's one of the highest, if not the highest. It's priced at $500 per share. And with Dow Jones being a price-weighted index, United Healthcare has a lot more weighting and has a lot more influence on the price of the Dow Jones Industrial Average than it does in, let's say, the S&P 500. So anyway, we had a remarkable turnabout there with the Dow, and all of a sudden we find ourselves at 52-week highs and an overbought cluster signal. You can see that this is not the first overbought cluster signal that we had for the Dow in the last 3 months. We did have another one right back here. If you want me to blow that up, let me maximize this here so you can see it a little bit better. Back here on April 28th, we also had an overbought cluster signal. Remember that little red dot that you see there on the chart will then correspond with the little red dot that you see on the indicator down below. And those overbought cluster signals occur when you have the green, the blue, and the red lines on the market forecast all in the upper reversal zone on the same day. Now this one did work out very well. Had you sold your shares in the Dow Jones or the DIA or whatever you were trading that was similar to the Dow Jones on this day on April 28th, you were quite happy about it, as you had to suffer a 4-day pullback had you not sold immediately thereafter. And the selling eventually got so bad that we went from overbought cluster signal there with that red dot to oversold cluster signal here with the green dot. That doesn't happen all that often, but that's almost a perfect example of how that can work out, where you can sell it when it's overbought, buy it back when it's oversold, and benefit in between. Had you been buying it here when everybody else was puking up their shares of those mega cap companies and nobody wanted to have anything to do with it as this was breaching prior support levels, well, you'll see that we actually ended that day with a nice long lower shadow and kind of a hammer formation there near a support area that led to a very spectacular rally on the Dow Jones to where we find ourselves right now. So, will this shake out the way that the other two did in terms of, playing the opposite direction? Hard to say. But, those of you that sold here and bought back here, you might be thinking pretty hard about selling again right here. Obviously, the momentum is quite bullish right now, but there is such a thing as too much of a good thing, so you have to keep that in the back of your mind as well. So the Dow and the Russell 2000 end today with overbought cluster signals on the daily candle chart. All 4 of these charts have strongly bullish postures according to the market forecast technical indicator, and all 4 of them are trading above their rising 30-day moving averages, telling us that the path of least resistance at this moment in time continues to be to the upside. All right, let's go ahead and pop on over here to the internet briefly. Let me see if I can find that. There it goes. I always like to get a chance to say thank you to those of you that help support these presentations. Remember that these presentations do take several hours of our day for both David and I when we do these, and we don't make money doing them, right? They are a free voluntary service that we offer in the hopes that we attract more people to our premium services, of course, where we do make money. But for those of you that enjoy these free presentations on YouTube, we ask one simple request out of you if you want to see them continued at the same pace that they have been in the past, and that is simply to help support us by clicking like on Twitter. It doesn't cost you a single penny. Now, some of you might be wondering, with Twitter starting to pay content creators lately, is that the reason we're always trying to get you guys to click like? That's not the reason. If that is a side benefit, then so be it. But the real reason that we've done this, and we've of course done this well before Twitter was paying its content creators, the real reason is we want the word to get out about Market Scholars. David and I know that we don't have a marketing department or an advertising team or anything like that like big financial companies do. We're just a 2-man operation here. So the best way that we can get the word out about our small business is through your guys's spheres, your social spheres that you have out there. So every time you click like or retweet or comment on our tweets, that's going out to your social circle as well. And we figure we can reach a much broader audience if you guys are willing to assist us with that. But if you're not willing to assist us with that, then we have to really second guess whether it's worthwhile doing these videos at all, right? Because of course, as busy business owners, it chews up a lot of our time to do it. So for those of you that do take the extra effort to click like for us, we really appreciate that. Thank you so much. 103 of you were able to do that for me the last time around. As I always say, as long as we're up and over 100 likes, I'm more than happy to do a full-length video as I'm doing right now. That would be closer to an hour in length. On the other hand, if you prefer just the 15-minute quick hitter videos without a trade application example and the 12 grids and the sector selectors and all that extra stuff that I give you in these hour-long ones, if you just want to keep it nice and short and simple, then don't click like. And if we're under 100 likes, then the next time I'm scheduled to do the video, I'll just plan on keeping it short and sweet for you. So So we let you guys kind of depend or decide that collectively to a degree. So let's do some shout outs here. Thank you to Claire, who was 103rd here today. Thank you to Irene, which was 102nd. Thank you to Business News, who proudly said that they were 101 in the replies. I saw that as well. I got a kick out of that. And then thank you to Sunita. She was number 100. And I've got to give a special shout out to Sunita because she actually became like number 100 in the midst of my dividend growth investing class earlier today. And you know, she's a little bit older. I don't think she would mind me mentioning this. She's in her 70s or 80s, and I get a kick out of her because she is always willing to learn new things. And I just hope that when I am at her age, that I have the same spirit and life within me to want to learn new things. And so I know sometimes technology is a little bit more challenging for you, Sunita, but I really did want to say thank you for putting in that extra effort. And thanks for being an inspiration to us as well, for your willingness to try new things even in your older age. There are some people that believe in the concept of you can't teach an old dog new tricks. And sometimes I fall victim to that myself. But I think we'll all have a better life if we stay open-minded and try to improve and change and get better each and every day, regardless of our current situation. So hats off to you there, Sunita. And thank you to Dave and to Dean and Jim and Keith and Greg and Brandon and John and Crame, and we've got Michael and DGI, and we've got Christopher and Nina and Ryan and Xavier and Dave and Ashok and Ash and Ken and Violina and Tom and George and Ken and Arthur. The list goes on and on and on. I can't get to all of you, but I do always want to say thank you to those of you that take that extra time out of your day to help David and I with this. It means a lot to us. Let's also have a little chat here about the sector selector. So the sector selector, as a reminder, does get updated on Friday evenings, and so it is a couple of days stale by now. Remember, those of you that are premium members of Market Scholars do have instant access. In fact, you have daily access to the sector selector if you're using Chart 1E on the Thinkorswim platform in our charting package that we offer you. But the reason that I produced this is for my Monday top-down trend trading class. That's the same class that I was mentioning earlier, where we own Microsoft and NVIDIA and Alphabet and a number of those you know, stronger trenders. As I mentioned on Twitter over the weekend, somebody had posted out there what the 50 best performing stocks in the S&P 500 were, and I went through all of them and I counted how many of them we own in just my top-down trend trading class. We own 10 out of those 50 best performing companies in the S&P 500. So that class has been en fuego here this year, and it is all because of tools like both the sector selector tool and then the associated stock selector tool that we use to make our decisions in that class. So it has been definitely a worthwhile endeavor for us to be utilizing these tools each and every week. So this week we really didn't have much in the way of change. As I mentioned, you know, to the class on Monday, we've actually had the exact same 4 top sectors since May 26th. If you go back here on May 26th, you can see on that week, technology was number 1, communications was number 2, industrials was number 3, and discretionary was number 4. If you look at every single week since then, the same 4 colors were up there in the top 4 rankings. Now they did switch here and there along the way. For instance, technology was number 1 for 5 weeks in a row, and then for the last 4 weeks they've been number 3, but they stayed in the top 4 during that entire stretch, as did the industrials, as did the discretionary stocks, as did the communication stocks. So that is fairly rare. We've used a tool like this for a long time in my trend trading classes, and I can tell you that that is not normal. Usually you have another one of these sectors that pop into favor, even if very briefly, and then they might fall out of favor. But it is rare to have the exact same 4 outperforming sectors week in and week out for basically 2 straight months. So that has been very unique to witness. And of course, this is a great batch of sectors to be leading the market. Those that have been in my top-down trend trading class over the years will have heard me state that if I had my way and I could wave a magic wand as to which sectors I would want to be outperforming to judge the health of the overall market and its bullishness, the 3 sectors I would select would be technology, communications, and discretionary. And since those are 3 out of the top 4, and the 4th one being industrials, which is a very cyclical sector that tends to benefit when the economy is strong, this is a very good breakdown or the way that you want to see the sectors and their leadership or lack thereof. Remember, at the bottom we have utilities and consumer staples. Those are areas that tend to outperform when the market is concerned and is having a challenging economic period. So we don't mind when the defensive areas sit out the rally. We want the growth areas to really be leading the way. So that is another way to judge risk appetite. And right now, risk appetite is high, and it has been for a couple of months at this point, according to how we would evaluate sector rotation. So anyway, we'll see if the coming months will have a change of pace or not, but so far it's been much of the same thing that's been leading the way in this market here in recent weeks. All right, let's go ahead and pop on over here now to the platform and do some 12 grid analysis. And we're going to get started here with chart 5A. This is our asset class 12 grid. And as you can see here, we have mostly green charts as we get started, with the exception of some of the corners there. And oftentimes we do start our conversation in the lower corner, so let's do that once again. In the lower left-hand corner here, you can see the US dollar is still in a bearish territory. In other words, a pink background color on this chart tells us that the market forecast posture on it is strongly bearish. And in this particular case, it should be obvious why. This is one of the more violent meltdowns that you'll ever see in the UUP. And it was pretty relentless. You had 1, 2, 3, 4, 5, 6 straight down days for the UUP. Remember, UUP is an ETF that's basically tracking the US dollar versus a basket of other currencies, largely led by the euro and the yen and a handful of others. But point is, you know, it's a somewhat diversified basket, and therefore you don't have as much aggressive movements if you were only comparing, let's say, the US dollar to like the Turkish lira or something like that, right? Where there's a much more obvious opportunity for a knee-jerk reaction of the currency pair based upon what's happening from a news perspective. So you should theoretically get less knee-jerk types of movements within UUP because it's the US dollar versus a basket of other currencies, not just one single other currency. And therefore it makes this even more abnormal. You do not see this type of movement. Remember, some of you might be looking at this over here, and remember I was with you that day when that happened. This was more of a glitch. They left it on there, but it was a function of how you know, the currencies were not fully open that day or something like that. There was some sort of a technical reason why this candle looks the way that it was. It was not organic. This is an organic move. This is actual legitimate pressure versus the US dollar here in the last, let's call it, week and a half or so. So it has been quite eye-opening to see the weakness come into the US dollar. And of course, that's helped support the price activity in a lot of other markets. Remember, these things do not happen in a vacuum. Typically, when the US dollar is weak, as it has been, commodities and foreign investments get strong on a relative basis. Take a look at this explosion higher here in EFA. This is the foreign developed stocks, right? Think Europe, think Japan, think Australia, and you have this massive move. I mean, it was looking sick here on July 6th, right? We were in a pretty significant downtrend at that point. But starting on July 7th, we basically just went straight up and went to multi-month highs in pretty much, you know, 2 weeks. So that all happened at the same time. The US dollar just completely fell apart. And you can see the same thing pretty much happened on EEM as well, where you had this very violent move to the upside. Its chart did not look nearly as weak as EFA ahead of time. Nonetheless, you had the same after effects of EEM making a violent move to the upside, especially compared to the S&P 500. And remember, the S&P 500 has had a spectacular move itself. It's just that in comparison, these others have been even more spectacular. So, you know, when you have a weak US dollar environment, it makes it a lot easier for stock market participants all across the globe to start seeing a few more gains enter into their brokerage statements. You also find that when the US dollar is weak, you tend to find that commodities start doing a bit better, and we have seen that here more recently. Notice that gold was in quite an aggressive downtrend, but once the US dollar rolled over, that gave gold an excuse to go up, and now all of a sudden we find ourselves above a rising moving average on gold, and it has a strongly bullish posture. We'll actually be talking about gold a little bit later on in the video as well, but this was once a sick looking chart that all of a sudden looks quite a bit more healthy today than it did just a couple of weeks ago, courtesy of that weakening US dollar. And then oil, kind of the same thing. Notice that oil was below its falling 30-day moving average just a couple of weeks ago, and now boom, we're all the way up here close to 3-month highs. Not quite there, but up in that vicinity where we're closer to highs than we are lows here all of a sudden. Again, part of the reason oil is priced in US dollars. When US dollars go lower or get weakened, or get weaker, then that has a tendency of strengthening the commodities that are priced in that currency. So we have had a kind of a push or wind in the sails of several different categories of investments out there, courtesy of that plunging US dollar. Let's talk about the U.S. Treasury yield now. Of course, that has been a big story here in the last couple of years in particular. Currently, we find that the TNX is trading at 3.78%. Remember, that's a 10-year U.S. Treasury yield on the Thinkorswim platform. You move that TNX over 1 decimal to the left. So basically, you have a 10-year Treasury yield just a hair under 4% right now, which of course is way higher than it was, let's say, 3 years ago. Remember, 3 years ago, we were talking about 10-year Treasury yields that were like 0.4%, not 4%, 0.4%, a tenth of where they're at right now. So it has been quite the dramatic change of the interest rate environment that we've had to endure here recently, courtesy of inflation and, of course, the Fed policy and all that kind of stuff. But we've actually had a pullback in interest rates here in the last, let's call it, week or so. And so that has a tendency that when we have falling yields, we have bond prices that rise inversely to that. And you can see over here that TLT, after putting in this oversold cluster signal here on July 10th, it then has rallied for every single one of the days since then, with the exception of July 14th. Every other trading day you've seen to the upside. So as the interest rate environment falls, bond prices themselves rise. And you can see that wasn't just U.S. government bonds that has that impact. You also saw foreign bonds rising. Foreign bonds are back above their rising 30-day moving average right now. As you can see, the moving average is colored green. You can also see that the moving average is colored green on high-yield bonds. Prices above a rising 30-day moving average, and high-yield bonds are getting closer to their 3-month highs here all of a sudden. Remember, high-yield bonds is another way to judge risk appetite. So similar to what I had mentioned about how we would evaluate the sector rotation as being very bullish for the markets right now, we could say the same thing with what we're witnessing there out of the high-yield bond market compared to the other bond categories. You'll notice that Bitcoin has pulled back the last 3 days. It is a hair below 30,000 right now. Of course, Bitcoin had this massive move a few weeks ago, a lot of that being led by some optimism around a potential spot Bitcoin ETF that could be in the works. A lot of people feel like BlackRock might be able to finally get that green lighted, and so that created a little bit of buzz there in the Bitcoin universe, but that's kind of starting to wear off a little bit here. It remains with a strongly bullish posture, and it remains above a rising moving average. It's just not able to keep up the momentum that it had here a couple of weeks back. Let's now take a look at the sector 12 grid. Now, a reminder that when we were looking at the sector selector tool here a moment ago, that was based upon an equal weighted system. This 12 grid that I show you here, which is chart 5C, is based upon a market cap weighted system. So stocks like Apple and Microsoft and Amazon and Tesla and Meta and Alphabet and Nvidia and even Exxon and Chevron are going to have a much bigger influence within each of these sectors than the prior view that I was showing you before. Sometimes they match each other. Sometimes there's little nuances that are a little bit different. Right now, I would say that things are largely in tune or in line with those two universes, because remember, on the sector selector, we had industrials as number 1, and then discretionary as number 2, and then technology as number 3, and communications as number 4. And as you look at those 4 charts right there, I don't think there's too much to argue with in terms of, are they leadership areas, even on a market cap weighted basis? And I would say emphatically yes. There is no question in my mind that those are still some of the strongest charts out there. Now, in addition to that, I would also throw in the financials here all of a sudden as kind of an honorable mention. Remember, for the longest time, we were not talking about financials at all in any form of being strong. But here I think you can get away with saying that, especially after today. Again, we had Charles Schwab as the best performing stock in the entire S&P 500 today. And you also had Morgan Stanley and Bank of America probably in the top 10 there as well. So anyway, those are big financials, and those companies are going to have a bigger influence on something like XLF compared to the equal weighted approach of financials. Nonetheless, this is a good proxy for what the financials are doing. And right now we're talking about financials at 3-month highs, right? The intermediate reading is at 93 right now. Obviously a strongly bullish posture. In fact, so strongly bullish that some of you are probably seeing that red dot there. As I zoom in, you can see that we had the green line, the red line, and the blue lines all closing above 80 here today on the market forecast, which then fires up the old overbought cluster signal. So we have this little red dot showing up down below, the corresponding red dot above the price candle here up above. So this is the first overbought cluster signal on the financial sector ETF, which is XLF, that we've had in at least 3 months. Let's go back 6 months, see if we had another one. We did not, even in a 6-month period of time. Let's go back a full year on a daily candle chart, and you'd have to go back almost a whole year since you last saw an overbought cluster signal on XLF, and that occurred back here. Didn't really have that best of track records because you did see the market was willing to continue to advance for a few weeks thereafter, but eventually you did start seeing some pretty aggressive selling off into the fall there. So anyway, we'll see if this one means anything to the market or not, but it is at least noteworthy in that it is literally only the second overbought cluster signal for the financial ETF in the last entire year if you're using daily candles. So that is at least worth pointing out. So financials very, very strong. In fact, so strong you're getting a rare overbought cluster signal. You could also say that the materials sector looks very strong right now as well. It hit a 3-month high here today, not necessarily multi-year high or anything like that, but a 3-month high nonetheless. And then you kind of have some of your underperformers with that bottom rung, right? That bottom rung is more of your defensive sectors. So think healthcare, staples, utilities, REITs. Those areas are still kind of just languishing, right? It's not that they're plunging or doing terribly. It's just that they're not keeping up with some of the more aggressive trends up there in the growth areas of the market. Energy also has been kind of hit and miss here more recently. Yes, it's above its rising 30-day moving average, but energy along with utilities are currently the only two that have a weekly bearish intermediate posture according to the market forecast technical indicator, which is why both of those charts have the pink background color. So energy we're kind of getting opposing thoughts with right now. It's trying to figure out whether it wants to be bullish or bearish. Utilities, it's a little bit more obvious. You know, it's trading below its moving average at the moment, that it's been bearish. Whether it continues to be, of course, anybody's guess. But there it's a little bit more obvious why that one is bearish. With energy, I think it's kind of, you could nitpick on that a little bit and say, well, you know, by this one indicator it's bullish, by this other it's bearish, and so on and so forth, right? And that can happen quite a bit, but I think here it's a little bit more visually obvious that that is the case. You could make the case that energy is trying to carve out, you know, kind of a rounded base here to a degree. So I don't necessarily think I would want to count it out yet. Then again, you can clearly see that it does not deserve to be talked about the same way that we talk about discretionary and communications and technology. Those charts are just off to the races, whereas energy is still well below where it was trading just 3 months ago. Okay, so on the whole, when you look at, you know, the sector breakdown on this 12 grid, you also get the same sense that I had mentioned before on the sector selector, which is the right areas of the market are leading the market right now. This is what we want to see in a bullish market environment. All right, let's now get into our trade application example for the day. I had mentioned before that we were going to talk about gold again, and that's what I opted to trade here today. Now, I tried to go through a lot of different charts, and I wasn't particularly enthusiastic with what I saw. I ran into a couple of problems as I was looking for trade ideas for the day. The first problem was, of course, we just started earnings season. And so earnings, really kicked off late last week with the banks, and we're now going to go through the next 3 weeks or so where we have a massive amount of earnings. Some of you don't mind trading through earnings. Some of you do, right? Everybody kind of approaches that topic a little bit differently. But if you're avoiding those companies that are about ready to report earnings, then that means that about a third of the market is, going to be cut out of your investable universe. So that was one problem that I saw. There were some decent looking charts out there, but a lot of them were going to report earnings like early next week, right? And you could have a situation where a perfectly good chart turns into a nightmare with, the snap of the fingers if you have the wrong set of information being delivered in the earnings conference call, as just one example. So that was one issue that I was running into. Another issue is kind of a good problem to have, which is there are a lot of charts out there that are so strong that they're not at a natural area of support, right? I feel a little bit more comfortable personally, and of course everything is a little bit different depending upon how you tend to look at it as an individual. We all look at these things differently. But for me, I've always felt a little bit more comfortable getting excited about a bullish trade if we are at a level of support. Where we find ourselves at this exact moment in time here on July 18th is a whole bunch of charts that have already broken out, many of them at new 52-week highs, like a Microsoft that I had mentioned before, where you didn't really pull back to a natural area of support. Now, that's not a guarantee that it will, right? It's just a matter of what you as an individual are comfortable with. And if this market keeps on rocketing higher, then those that are waiting for a natural level of support might continue to be looking from the outside inwards towards the market. So that is one of the risks that you have when you think in that way. But it is true that each one of us has to kind of judge for ourselves how we view the market. And that was what I recognize out of a lot of charts today is there's a lot of great looking trends out there, but a lot of those trends are so far extended that they're not at a natural level of support. And so they kind of gave me a little bit more of a nauseous feeling. There's a few of them that look okay out there. One of them that I thought was kind of interesting was Oracle, but the problem was I really didn't have a lot of great options contract liquidity that I could deal with there either. So, but that's an example of a rare one where you already reported earnings and you're getting somewhat of a bounce up and off of that rising moving average. So some of you might want to look at a bullish trade bounce idea there off of Oracle. But what I opted to do here for the official trade example, and remember I've already done this trade, and so for those of you that are premium members of Market Scholars, I do these trades while the stock market is still open, and then I send out the trade details in our private Telegram channel, so that way you guys can be alerted before the market closes, as opposed to those that will watch the free video later on that night on YouTube. So what I opted to do was just a simple iron condor on GLD. Remember, the benefit of GLD is it is a tracking instrument that tracks the price of gold effectively, is what it's designed to do. And since gold is a shiny yellow metal, it doesn't report earnings. And so that's one of the benefits here. If you're concerned about all the earnings announcements we'll have in the next 3 weeks, GLD doesn't pay earnings or doesn't deliver earnings. So as an ETF, we get the advantage of avoiding a potential disruption in a chart. So that is a key benefit there of GLD. In this case, I went out to the September monthlies, and I opted to go with a couple of strikes that were outside the range of this particular chart over the last 3 months. So on the top side, I think I went with 192, I believe, was the sold strike. On the call side, it was probably the 192 that I sold and the 193 that I bought. And then on the downside on that iron condor, it was the 175 that I sold on the put side and then the 174 that I bought. So that created a credit of around 25 cents, and that is about a 33% return on risk for those strike levels. And what it gives me the advantage of is saying that if GLD basically continues to trade within the range that it's already traded in over the last few months, if it continues to do that in the next few months, then I get to make money based upon a neutral chart strategy. Now, obviously, if gold does break out above its highs back here on May 4th or breaks down below its lows that it had over here on June 29th, then my trade will be in jeopardy. But until then, I will make money off of time decay if this thing can kind of stay within that range. So I'm hoping that gold just kind of neutralizes here and tracks sideways here in the next couple of months. So that's what I had for you here today. As always, I appreciate you guys checking out tonight's video. If you like these hour-long presentations that include the additional analysis with the sector selector and the 12 grids and these types of trade application examples, I have one simple request for you. Simply click like. As long as you're up and over 100 likes there on Twitter, by the time I'm scheduled to do the video again on Thursday, I'll be more than happy to deliver another hour-long presentation for you on that day. On the other hand, if you do prefer those shorter 15-minute versions of the video instead, then don't click like. And if we're under 100 likes, then I'll just plan on keeping it short and sweet. So we'll let you guys decide that collectively. Whatever you decide for yourself, thanks again for checking out tonight's video. I want to wish you all the best of success with your trades and your investments. Goodbye for now.